Good evening to everyone. Again, my name is Jim Lumberg. I'm the financial advisor to the foundation, and um, uh, really appreciate the opportunities to be of service and to be with you this evening. We titled the presentation "Soft Landing." Ask the consumer, and I think the reason that we felt that that was appropriate is, a perennial question in investing is, where does the market go from here? And over the last few times that we've been together, I think we've presented an equally compelling case for a bull or a bear market. And the data that we've seen over the many months has been not definitive. It can lead you to a number of different directions, and but one part of the data that has been consistently strong is the consumer, and the consumer hanging in there and really being a ballast and a catalyst and an engine to this market. So the consumer, as we go through the presentation tonight, will be a key theme. It was a key theme in Chris's newsletter to us, and it's really important, I think, to understand the current market is to understand what's going on with the consumer. These numbers are as close of the week last week, so as of close of market on Friday. And it just is a chance, let's just check in on equity markets around the world. I think the primary story here is really the markets are fairly flat. The S&P is up just 7% year to date. It's down from its highs in July. We'll talk about that in a moment. The Dow's, the largest 30 industrial stocks, are actually down year to date. The real return has come from the NASDAQ, which is up 20% year to date. And if you look at the return within the NASDAQ, it really is a fairly narrow return. It's only driven by three sectors. It's concentrated in a small number of companies and primarily concentrated in very large cap companies. So the returns have been in the NASDAQ in a concentrated way. But if you look at the Russell, which is a much broader look at small cap stocks, they're down. They're down 7%. So again, it's highly concentrated, the positive returns. Overall, Europe is flat. China's basically flat. And if you look at all equities across the world, they're up just about 4% year to date. If we look a little closer at the S&P 500, it's down about 7% from its high in July of 4607. And with the close of October marked the third consecutive month that the S&P had a negative return. And this graph just visualizes that data for us. In terms of the performance, if we look at the S&P 500, as I said a moment ago, it really has been concentrated in three primary sectors: consumer, discretionary, information technology, really driven by speculation around AI primarily, and then communication services. And that includes big companies like Google and Meta and others. But again, look at the importance of the consumer. The consumer really has been an important driver in this market, as illustrated by the sector performance. And one of the slides that Chris included in his third quarter letter to us, I've copied and we're using again. If we look at the growth in the overall economy, and we'll talk about this later in the presentation, up nearly 5%, almost or more than half of that growth has been attributed to consumer spending. So it really is an important part of understanding the overall returns and the drivers in the current market. If we look at the S&P, the PE ratio, which is the ratio of price to earnings, the amount that a investor is willing to pay for a dollar of earnings, the PE ratios have really come back much closer to historical norms, trading around 17% up from their highs of over 17 times over their highs, exceeding 20 times. And the PE ratio really has been a primary driver in valuations. Earnings have really hung in there pretty well. I'll show you in a moment a slide on that. Earnings have hung in there. It's been a deterioration in the PE ratio that really has driven stocks down over the last few months. Earnings, as I just said, have actually been positive year to date, and market consensus is that they'll continue to be positive and grow, and that we're going to see, after a earnings recession, that we're going to see a rebound of earnings growth, which of course is the primary driver of equity values and really an important part of a healthy economy. With that, a few slides to talk about yields and what's going on in the fixed income market. A bellwether for fixed income is to look at the 10-year Treasury yield. This is a graph that shows 10-year Treasuries over the last 6 months. Now, 10-year Treasuries closed just today at 4.66 or 4.65%. It's, as you can see, a high for the year. It's important not only on its relative or its absolute basis, but also the 10-year Treasury in terms of the yield curve. We've talked a lot when we've been together over the last few times about the inverted yield curve, which means that near-term or short-term interest rates are higher than long-term interest rates, which causes an inverted yield curve, which has real significant implications for a market. Today, the yield curve remains inverted. 2-year Treasuries are closing today at about 5% yield. The 10 years, I said, is closed at 465. So the inversion of the yield curve is about 35 basis points. It's down significantly from where it was early in the year at 100 plus, which shows an optimism in terms of the market and a constructive view of the market going forward. But nonetheless, the yield curve remains inverted. That's really important for a number of reasons, primarily because an inverted yield curve has, with great accuracy, been a predetermined or a leading indicator to recessions. And very rarely does an inverted yield curve not lead to a recession of some type. So, we talk about mixed data in the market. The yield curve, the inverted yield curve, is probably the strongest argument for the bears in terms of just saying the yield curve has been inverted for such a long period of time. It must lead certainly to some level of recession. So that's why we look at it so closely. If we look at overall Treasury yields, and again, let's focus on 10-year Treasury yields, nearing 5%, 4 3/4. You can just have a historical context. It's been about 16 years ago since we saw 10-year yields at the levels that we are today, near and around or just over 5%. So it's been a couple of market cycles. It's been a while since we've seen yields at this level, for sure. Where do they go from here? Well, one way to answer that is to look at the Fed rates. And this is a graph that shows Fed funds rates and increases and decreases in Fed funds rates plotted against the 10-year Treasury yield. And what we've seen is that the cycle for Treasury yields almost always reaches a peak of what the Fed funds rate was at its high. Today, the Fed funds is at 5.25 to 5.5%. Treasury yields at 465. So it would argue, at least on this metric, that interest rates will continue to rise somewhat. And if you think about a continuing flattening of the yield curve, that would be another reason that we would expect interest rates to increase. However, that being said, as the Fed met this week, they held their interest rates unchanged. So the Fed funds rate at a target of 5.25 to 5.5%. the Fed is in a wait and see mode in terms of what they're going to do with interest rates, and really for good reason. They have a balancing act. They want to push the economy, but not push it into a recession. They want to cool it off. And if they can do that by lowering inflation, by maintaining a stable job market and growing economy, then that's exactly what they're trying to do. That would be called a soft landing. So when we look at the data that the Fed is looking at, they're kind of they're checking all of the boxes in terms of their tightening program. Inflation, after spiking and reaching 9%, has convincingly continued downward. This is changes in CPI to the present. And when we look at the Fed's favored number, PCE, which is the personal consumption expenditures, it's actually even more convincing in terms of asset prices stabilizing and hopefully moving back to the Fed's long-term target of 2%. And while asset prices continue downward trend, we see employment continue to hang in there. The last print of the employment number was in September, and it was unexpected and resilient was the headline at the time, with some significant job growth. So a strength in the job market continues, and strength in the overall economy. Just at the end of October, there was a release of GDP. It showed 5% annualized growth in the third quarter GDP, which, as you can see, is a strong uptick from recent quarters. And it really speaks to, the success that the Fed is having. And if we come back to the consumer again, what we're seeing is a scenario where the consumer continues to spend in terms of personal consumption, and we see GDP increasing while inflation continues to come down. So this is kind of the classic best case scenario. So where does that lead the Fed from here? Well, if we're at 5.5% now on Fed funds rate, if you look out to projections from leading economists targeting rates in 2025 and 26, most see a stable program through 24, but getting into 25 and 26, a unwinding of the Fed's program and bringing interest rates back down again, which would be good for the economy. So again, back to the consumer, and if that is all the case, that we really may be in the midst of a soft landing. I'm not personally ready to declare that, but the data sure is supporting that conclusion. And thanks in large part to the consumer and the resilience of the consumer in this market. But at the end of the day, whether the market goes up or down, or interest rates go up or down, or whatever the case, it's impossible to predict and know for sure. So it leaves us still with a perennial question of where does the market go and what should we do when we have money to invest? And I think the tried and true lesson that has proven a timeless lesson is not to try to predict the market, but rather think about the purpose of money and think about time horizons. And if you understand the purpose of money and the time horizon for investments, as Chris had noted in his third quarter letter to us, it really is a pretty straightforward exercise to determine how you should invest those funds.